Hey, what's happening, Bulls and Bears? It is Monday, June 13th, 2022, back with another dose of economic reality. And today was another bloodbath on Wall Street. We're going to talk about that. We're going to talk about mortgage rates. Mortgage rates are going to take another big leap higher. And this is good news for people waiting on the sideline for the housing market to correct, for home prices to come down. It's going to take a little while. There's still a lot of big money out there, still big investors scooping up homes. So we're going to talk about that in a bit here, but let's start with the markets today. The stock market, deep in the red. Another 2.8% shaved off the Dow Jones. That's a drop of over 870. S&P down 3.8%. The Nasdaq, one of the biggest losers of the day, down 4.7%, but the Russell 2000 down 4.76% today. Red across the board. The market's not liking the rate hikes and the talk of further rate hikes. Now they're coming out and saying they're going to raise rates another 0.75%. And so far up until now, we've seen these 50 basis point bumps, and the 0.75% has got markets spooked, to say the least. For those looking to buy the dip or bottom fish, this is not the bottom until they come around and start talking about cutting rates again, re-implementing QE, meaning further purchases on the balance sheet there with the money printers. Then I don't see a bottom. For those of you that are seeing your savings, not your savings, but your retirement accounts, which is saving for retirement, but retirement accounts, 401ks getting blasted, getting decimated, you might want to think about looking into a money market or a cash equivalent account. Sometimes they're referred to as stable fund accounts, money markets. Take a look at your 401k provider and see if that option is available, if that is a concern to you. All right, I know I've said that before. I think a lot of you already know that, but I still see in comments people in despair and kind of freaking out that their retirement accounts are getting decimated. It doesn't have to. There's cash equivalent accounts, money markets that are not tied to stocks. In fact, many of those savings instruments, those money market accounts, are tied to bonds, and bond yields are rising. So you're going to see a bigger yield now on your money that you have in that account. Let's talk about yields here and mortgage rates. We know that the mortgage rate is basically tied to or affected by the 10-year yield, and yields are rising because of what the Fed is doing. They're reducing their balance sheet. Let's take a look at that 10-year yield. Another spike today in the 10-year Treasury yield, and these increases are going up even faster. Yeah, this is a big one. Over 6.5% bump up today to 3.3, and mortgage rates will follow this higher. And let's go ahead and bring up a chart here on mortgage rates. If you look to the far right here, you're going to see the MBA in the blue line. That's the Mortgage Banker Association here, surging with the 10-year Treasury yield. So expect more weakness in the housing market. Now, so far, we have not seen any significant price declines except for Chicago, which is actually down year over year. But if this continues, and I really hope this continues, I hope mortgage rates continue to skyrocket. That way, people that actually have cash saved up can get a better deal. And when home prices go down, your down payment that you've been saving up for becomes 20% a lot faster when home prices go down. The problem is there's still a lot of investing investors, flippers. Now, flippers are going to start fading away as home price growth diminishes. But you still have the big money out there, the big hedge funds, the big corporations, big money investors out there scooping up homes. Basically, 1 in 3 homes that are sold to somebody as a second home, as an investment, or both. And some people buy a second home and rent them out in the summer and do Airbnb. So sometimes it's a combination of both of those types of second home investment property purchases. Now, I was watching some of the news stations today, and they seem to think that this was a big surprise, that they're surprised that the markets are coming down. Nobody saw this coming. Every one of us here in this channel knew this was coming. Inflation, rising prices hurts the consumer. People are paying all this money for gas and energy and car prices, home prices. The middle class, the average working person, is going broke. Savings are dwindling. And when the entire economy is propped up on consumer spending, that is a problem. So please, my viewers, don't get caught up on the wrong end of this thing. Don't put all your money in. I'm not giving advice, but research before you do this. I wouldn't be bottom fishing right here. Some people are, but I'm not bottom fishing. Hold your cash, because if this continues, much better buying opportunities will be down the road, whether it's the stock market, real estate. Markets dependent on low interest rates are going to be affected by this. But looking at the big picture, these debt levels for consumers are dangerous. And people holding revolving debt, people with credit card debt right now, be very careful, because interest rates are going to rise on those credit cards. It's not fixed like a mortgage. And if you're not paying off that card in full each month, this could be the financial end of the line for you. Unless you're getting wage increases to match the rising cost of living, which most people aren't. I'd say 99% of the people are not. Maybe if you're a CEO somewhere, you are. Your pay raises are probably outpacing the rising cost of living. But for most people, no. Wage increases are nowhere near keeping up with the cost of living. So if you're not paying your card off in full each month, you're not ever going to be able to pay it off in full. It's going to be the end of the line. So get ready, because there's going to be a bankruptcy storm coming up later this year if this continues. Now, there's a segment of the population out there that watches these types of things, and they're saying that they're just going to turn around, start cutting rates. I hope that doesn't happen. And as you know, most of you know, I've not been a fan of the Fed and what they do. They've been wrong on so many things. They've overcompensated here. They've underestimated previous bubbles and market corrections, either one on purpose or two just out of idiocy. But either way, it doesn't matter. What matters is that you stay on top of these markets and you get ready for what's coming. So if the Fed continues to do what they're doing here, allowing rates to rise, shedding their balance sheet, then I don't see what's going to stop this bear market. And if you have cash, you're going to have better opportunities down the road. But I've said it before, holding cash in this environment where the costs are going up so rapidly, it's going to be more and more difficult. It's only going to be for the people that are really strict and diligent on their spending. And for those people that have a long work commute with these gas prices right now, it's going to be especially difficult for you. People that are trying to raise a family of, a big family, 3, 4, 5 or more people, the cost of food, the cost of transportation, it's going to be very difficult for most people. People are getting hurt right now financially. I know people personally that are on the edge financially. They're talking about bankruptcy. And it's interesting because a lot of people that my wife follows on Facebook, she's very active on Facebook, I'm not. A lot of the people that looked the wealthiest, that looked like they were doing the best, people that showed pictures of their new homes in the past few years. There's a family in particular that my wife is friends with, and they showed their new swimming pool getting installed a couple years ago. They bought a new home. Now they're getting divorced, and it's like it's about 4 out of 10 people that my wife follows on Facebook are getting divorced. And I think a big part of that is the financial situation. And when the money goes, a lot of times your significant other goes too, if you know what I mean. That's just the way it is. I'm not happy to see that happen, but it's definitely not a surprise considering these levels of debt right now and the cost of living. So if you're in a relationship right now, hopefully you can keep it together. And you've got to really be strong at these times, because it's going to take a partnership and an agreement on how you're going to navigate this financially. And a lot of people just aren't going to make it through this and still stay together, if you know what I mean. So whether you're with somebody or by yourself, hope you're doing good and hanging in there during these times. Thanks for being here. Also, thank you to the following viewers for your super chats: Maria, Avery, Art, Greg, and Rick. Thank you for the super thanks, I guess they're called. To those of you that don't know, there is a way to help me down. It's called super thanks. If you like what we talk about here, For those that have sent me tips, thank you very much. It goes into my coffee fund. And yes, coffee is very important for making these videos. So thank you very much for your support. And we're going to keep on top of the markets here for you, let you know what's going to happen down the road. So you're going to be better prepared, better than most. Thanks for being here. Big love, people. Bye. Peace.